All right, lock in for the next few minutes because what I'm about to walk you through is not speculation, it's not theory, and it's not another financial headline designed to generate clicks. This is about a mechanism that is already operating inside the U.S. banking system right now in February 2026 that directly affects your ability to access retirement funds, withdraw savings, and move money between accounts. I'm talking about liquidity controls, transaction limits, and what regulators call enhanced monitoring protocols that have been quietly implemented across regional and national banks over the past 18 months. If you think your checking account balance represents cash you can access on demand, you need to understand how the rules changed. Between January 2024 and now, over 40 institutions have imposed new withdrawal restrictions, delayed transfer approvals, and flagged routine transactions under updated Treasury Department guidance. This isn't coming. It's here. The Federal Reserve, the Office of the Comptroller of the Currency, and the Financial Crimes Enforcement Network have all updated operational frameworks that give banks discretion to restrict access during periods of what they define as elevated risk. And we are in one of those periods right now. What makes this critical for anyone planning retirement or managing household savings is that these restrictions don't require advance notice, they don't require your consent, and they operate within a legal structure that was rewritten after the 2008 financial crisis. In this video, I'm going to walk you through exactly how these restrictions work, why they're being deployed now, what historical precedent tells us about where this leads, and most importantly, what you need to do this week to ensure your retirement funds and emergency savings remain accessible. This is not about fear. This is about understanding the rules that govern your money and making decisions based on facts, not assumptions. Stay with me because by the end of this breakdown, you'll have a clear picture of what's actually happening and a specific action framework. Let me establish the foundational concept that will frame everything we discuss today. It's called liquidity mismatch, and it's the structural vulnerability built into every fractional reserve banking system. Here's how it works. When you deposit money into a bank, you assume that money is sitting in a vault waiting for you to withdraw it. But that's not how banks operate. Banks take your deposit and immediately lend it out, invest it in securities, or use it as collateral for other transactions. They keep only a fraction of total deposits on hand, typically between 3 and 10%, depending on the institution and regulatory requirements. This works fine under normal conditions because withdrawals and deposits roughly balance out on any given day. But the moment a large number of depositors want their money at the same time, the system breaks. The bank doesn't have the cash. It has loans, bonds, and other assets that can't be converted to cash instantly. That's liquidity mismatch. And when it happens at scale, you get what happened to Silicon Valley Bank in March 2023, what happened to Signature Bank the same week, and what happened to First Republic 2 months later. All three institutions failed not because they were insolvent, but because they couldn't meet withdrawal demand fast enough. The regulatory response to those failures was not to require banks to hold more cash. It was to give banks more tools to control outflows. That's what we're seeing now. The restrictions being implemented are not violations of banking law. They are applications of updated regulatory guidance that allows banks to manage liquidity risk by limiting your access. Now let's ground this in history because the pattern of restricting access to deposits during financial stress is not new. It has happened repeatedly, and every time it does, the people who understand it early are the ones who protect their wealth. The first major example in the United States was the banking holiday of March 1933. Between 1930 and 1933, over 9,000 banks failed as depositors rushed to withdraw their money and banks couldn't meet the demand. On March 6, 1933, President Franklin Roosevelt declared a national banking holiday, closing every bank in the country for 4 days. During that period, you could not access your money, you could not cash a check, you could not withdraw funds. The stated purpose was to stop the panic and allow banks to stabilize. But here's what actually happened. When the banks reopened, not all of them did. More than 5,000 remained closed permanently, and the ones that reopened operated under new rules. Withdrawal limits were imposed, transactions were scrutinized, and Executive Order 6102, signed 2 months later, required citizens to surrender gold coins and bullion to the Federal Reserve at a fixed price of $20.67 per ounce. Once the government had centralized the gold supply, they revalued it to $35 per ounce, effectively devaluing the dollar by 40%. The people who had kept cash in banks saw their purchasing power cut. The people who had moved into hard assets before the restrictions came down preserved their wealth. The lesson here is not that a 1933-style banking holiday is imminent. The lesson is that when the system is under stress, access restrictions happen fast. They happen under the authority of emergency powers, and they are presented as temporary measures to restore stability. The second historical case that's directly relevant is the savings and loan crisis of the 1980s and early 1990s. Over 1,000 savings and loan institutions failed during this period, and the Federal Savings and Loan Insurance Corporation, which insured those deposits, became insolvent. Depositors at failed institutions faced delays of months or even years before receiving their funds, and in many cases they received less than their full deposit because the insurance fund didn't have enough capital to cover all claims simultaneously. What saved most depositors was the federal government stepping in with taxpayer funds to recapitalize the system, but the process was slow. There were restrictions on how much you could withdraw, even from institutions that were technically still operating, and the entire episode revealed that deposit insurance is only as strong as the fund backing it and the political will to honor it. Right now, the FDIC insurance fund covers roughly $250,000 per depositor per institution, but the total amount of insured deposits in the U.S. banking system is over $10 trillion. The FDIC fund itself holds about $128 billion. That's a coverage ratio of roughly 1.3%. In a systemic event where multiple large institutions face runs simultaneously, the fund doesn't have the capacity to pay out all claims at once. That's why the regulatory shift has moved toward restricting outflows rather than guaranteeing payouts. Let's move into the current environment and break down what's actually happening right now in February 2026. Since January 2024, the U.S. Treasury's Financial Crimes Enforcement Network has issued updated guidance under the Bank Secrecy Act, requiring enhanced transaction monitoring for transfers above certain thresholds, frequent withdrawals, and account activity that deviates from established patterns. This guidance doesn't set hard dollar limits. It gives banks discretion to flag and delay transactions based on internal risk models. What this means in practice is that if you've been making regular monthly withdrawals of $2,000 for years, and suddenly you need to withdraw $10,000 for a legitimate expense, the bank can hold that transaction for review. They can request documentation, they can require in-person verification, and they can delay the transfer for up to 7 business days under anti-money laundering protocols. This is not a theoretical risk. Reporting from regional bank customers in Texas, Florida, and Ohio over the past 6 months shows delays on retirement account withdrawals, holds on wire transfers for home purchases, and requests for detailed explanations of why funds are being moved between accounts at the same institution. These are not criminal investigations. These are standard operating procedures under the updated framework. The banks are not doing this because they want to inconvenience you. They're doing it because regulatory examination standards now penalize institutions that don't demonstrate robust monitoring. And in an environment where liquidity is tight and banks are holding underwater bond portfolios from the 2020 and 2021 zero-rate period, they have every incentive to slow outflows. Now let's connect this to the retirement planning context, because that's where the impact is most acute. If you're 55 or older and planning to retire in the next 5 to 10 years, your retirement funds are likely sitting in one of 3 places: a 401k or 403b plan managed by your employer, an individual retirement account at a brokerage or bank, or a combination of both. The rules governing access to these funds are complex, and they've been tightened significantly over the past 2 years. Starting in 2024, the IRS updated required minimum distribution tables under the Secure 2.0 Act, changing the age at which you must begin taking withdrawals and adjusting the calculation method. But what most people don't realize is that even if you're past the RMD age and legally entitled to withdraw your own money, the custodian institution still has discretion over the timing and method of distribution. If you request a lump sum withdrawal from an IRA and the custodian flags it as unusual activity, they can delay the distribution pending review. If you request a rollover to a different institution, the receiving bank can impose additional verification steps that stretch the timeline. And if you're withdrawing from a 401k that's still held at your former employer's plan, you're subject to that plan's distribution rules, which can include mandatory waiting periods and processing delays. These are not legal violations, these are administrative procedures, but they create friction. And in a period where banks are managing liquidity carefully, that friction increases. The mechanism that makes this worse is what's called the qualified plan liquidity trap. Retirement accounts are designed to be long-term savings vehicles, and the tax code imposes penalties for early withdrawal to discourage you from accessing the money before retirement age. That's the intended design. But it also means that even after you reach age 59 and a half, when the 10% early withdrawal penalty no longer applies, you're still subject to the custodian's operational procedures. If that custodian is experiencing balance sheet stress, if they're managing large unrealized losses in their bond portfolio, if they're facing deposit outflows in other parts of their business, they have every reason to slow retirement account distributions because those distributions require them to liquidate assets and move cash out of the institution. This is not speculation. This is how liquidity management works. And we saw this exact pattern in early 2023 when Silicon Valley Bank failed. In the weeks leading up to the collapse, customers reported delays in wire transfers, holds on large withdrawals, and requests for additional documentation on routine transactions. Those were warning signs. And the people who recognized them and moved their funds to other institutions before the FDIC took over were the ones who avoided weeks of uncertainty. Now let's talk about the three mechanisms that are expanding right now and why they matter for your retirement planning. The first is enhanced monitoring under the Bank Secrecy Act and anti-money laundering regulations. This framework was originally designed to prevent terrorist financing and money laundering, but over the past 5 years it's been expanded to cover a much broader range of transactions. The current threshold that triggers automatic reporting to FinCEN is $10,000 in cash deposits or withdrawals in a single day. But banks are now required to monitor for structuring, which means breaking up transactions into smaller amounts to avoid the reporting threshold. If you withdraw $4,500 on Monday and another $4,500 on Wednesday, that can be flagged as potential structuring even if you had legitimate reasons for both transactions. Once flagged, the bank files a suspicious activity report with FinCEN. You're not notified. There's no due process, and that SAR stays in the system permanently. The problem for retirees is that many people withdraw cash regularly to cover living expenses, property taxes, or medical bills. If those withdrawals happen to fall into a pattern that the bank's algorithm flags, you can end up with restrictions on your account without ever knowing why. The second mechanism is the regulation delimitation on certain types of transfers. Although the Federal Reserve suspended enforcement of the 6-transaction limit on savings accounts during the pandemic, many banks have reimposed internal limits as a liquidity management tool. This means that if you have a money market account or a savings account that you use to hold emergency funds, you may be limited in how many times per month you can transfer money out of that account. Exceed the limit, and the bank can convert your account to a checking account, impose fees, or close it entirely. For someone managing retirement cash flow, this creates a problem. If you're using a high-yield savings account to hold your RMD withdrawals or pension income and you need to transfer funds to cover an unexpected expense, you could hit the transfer limit and find yourself unable to move money when you need it. The third mechanism is the custodial hold authority embedded in retirement account agreements. When you open an IRA or roll over a 401k, you sign a custodial agreement that gives the institution the right to delay distributions under certain conditions. Those conditions include pending legal actions, IRS levies, divorce proceedings, or any situation where the custodian determines there's a risk of fraud or error. The language is broad, and it's designed to protect the institution from liability. But it also means that if the custodian's compliance department flags your withdrawal request for any reason, they can hold it for review. And that review period is not defined. It can be 3 days. It can be 3 weeks. You have no control over the timeline. So what does this mean for your retirement plan? It means that the assumption most people have that their retirement savings are accessible on demand once they reach retirement age is not fully accurate. Access is conditional. It depends on the operational status of the custodian institution, the regulatory environment at the time of withdrawal, and the internal risk controls that the bank has in place. This is not a reason to panic, but it is a reason to structure your retirement assets with redundancy. You don't want all your funds at a single institution. You don't want all your liquidity tied up in accounts that have transfer restrictions. And you don't want to wait until you need the money to discover that access is slower than you expected. Now let's talk about what you need to do right now. The first step is to conduct a liquidity audit of your current retirement and savings structure. Go through every account you have and identify where your funds are held, what type of account it is, and what the withdrawal rules are. If you have more than $250,000 at a single institution, you're holding uninsured deposits. That's direct exposure to the risks we've been discussing. The action here is to spread those funds across multiple institutions to stay within FDIC coverage limits. If you're married, you can structure accounts as joint ownership, which gives you $500,000 in coverage per institution. But you need to verify that with the FDIC's online calculator because the rules are specific. The second step is to establish a cash liquidity buffer outside the banking system. This doesn't mean withdrawing everything and stuffing it under a mattress. It means holding a portion of your emergency savings in instruments that you control directly. For retirees, this typically means 3 to 6 months of living expenses in physical cash held securely at home, and an allocation to short-term Treasury bills that you can liquidate without going through a bank. Treasury Direct allows you to purchase T-bills directly from the government, and you can set up a linked bank account for redemptions. This gives you access to funds that are backed by the full faith and credit of the U.S. government with no intermediary risk. The third step is to diversify your retirement account custodians. If your IRA is held at a single brokerage, consider splitting it into multiple accounts at different institutions. Yes, this creates more paperwork. Yes, it's less convenient, but it reduces concentration risk. If one custodian experiences operational issues, you still have access to the other accounts. The fourth step is to understand the distribution rules for your specific retirement accounts and plan your withdrawals in advance. Don't wait until December to take your required minimum distribution. Spread it out over the year. Don't request lump sum withdrawals unless absolutely necessary. Structure your cash flow so that you're taking smaller regular distributions that don't trigger monitoring thresholds. And document everything. Keep records of every withdrawal request, every transfer, every communication with your custodian. If there's ever a delay or a dispute, you'll have the documentation to resolve it. The fifth step, and this is where most people hesitate, is to consider holding a portion of your retirement savings in assets that exist outside the traditional financial system. I'm not talking about speculative investments. I'm talking about physical assets that have intrinsic value and can't be restricted by a bank's liquidity controls. For retirees, this typically means an allocation to physical precious metals, specifically gold and silver, held in your possession or in secure private storage. The reason this matters is that physical metals are not someone else's liability. They're not a claim on a bank's balance sheet. They're not subject to custodial holds or withdrawal limits. You own them outright. And in an environment where access to traditional accounts is becoming more restricted, that optionality has real value. The allocation doesn't need to be large. For most retirees, 5 to 10% of liquid assets in physical metals is sufficient to provide insurance against access restrictions and currency debasement. The key is to work with a reputable dealer, take delivery, or use allocated storage, and avoid numismatic premiums. Now let's address the question that's probably forming in your mind. Is this really necessary, or is this an overreaction to regulatory changes that won't affect most people? The answer depends on your time horizon and your risk tolerance. If you're 30 years old with decades until retirement, you have time to adapt to whatever changes come. But if you're 62 and planning to retire in the next 3 years, you don't have that luxury. The restrictions being implemented now are not temporary pandemic measures. They're permanent changes to how the banking system operates in a high-debt, low-liquidity environment. And the trajectory is toward more controls, not fewer. We're seeing this globally. In Canada, the government invoked emergency powers in 2022 to freeze bank accounts associated with protest activity. In China, banks have imposed withdrawal limits and frozen accounts during periods of regional financial stress. In Europe, negative interest rates and bail-in provisions have been normalized. The United States is not immune to these trends. We have the legal framework in place, we have the regulatory precedent, and we have the financial conditions that make restrictions more likely, not less. The goal here is not to create alarm. The goal is to create awareness. Your retirement savings are the product of decades of work. You've paid taxes on that income. You've followed the rules. You've saved diligently. And you have every right to access those funds when and how you choose. But the system you're operating in has changed. The rules have been rewritten, and the assumptions that guided your parents' generation no longer apply. Understanding this is not pessimism, it's realism. And acting on it is not paranoia, it's prudence. The people who come through systemic transitions with their wealth intact are not the ones who hope for the best. They're the ones who prepare for multiple outcomes and structure their assets to withstand disruption. So here's what I want you to do after watching this video. First, conduct the liquidity audit I described. Identify where your money is, how it's structured, and what the access rules are. Second, establish redundancy. Multiple institutions, multiple account types, multiple asset classes. Third, document your retirement cash flow plan and start taking distributions in a way that minimizes friction. And fourth, allocate a portion of your savings to assets that you control directly, outside the banking system. If you do these 4 things, you'll be positioned for whatever comes next. And if the restrictions never escalate beyond where they are today, you've simply built a more resilient financial structure. There's no downside. Before we close, I want to hear from you. Have you experienced any delays or restrictions when trying to access your retirement funds or move money between accounts? Drop your experience in the comments because this is data that doesn't get reported in official statistics, but it's happening in real time across the country. And if you found this breakdown valuable, if it gave you clarity on what's actually happening and a specific framework for protecting your retirement savings, then hit that subscribe button and share this video with anyone you know who's planning for retirement. This is information that most people won't hear until it's too late. And the window for taking action is narrowing. The restrictions are here. The mechanisms are operational. The question is whether you're going to structure your retirement assets to account for this new reality, or whether you're going to assume the old rules still apply. I'll see you in the next one.